Who knows? All right. So today we're talking about one of my favorite subjects, which is what, David? Interest rates.
Interest rates, exactly.
And this is timely because as of the date of this recording, the Fed has just recently, cut interest rates. And oh, what happened? All right, we're still going though, right, Dave? Anything with you on your
We're still
side?
here. Still here.
All
Okay.
right, ignore that, people, because something weird happened there. In any case, we're talking about interest rates and the Fed, the Federal Reserve, which has a hand in monetary policy in the United States, cut what they call the discount rate, or the funds. I should say it's the discount rate, but it's really part of the Fed funds rate and these kind of things. And so a lot of people hear these things like interest rates were cut, and they think that, oh, that's really cool because my car loan gets cheaper, my mortgage gets cheaper, or my credit card's cheaper, all those kind of things. What says David?
What says me? Yes. Well, let's just start with interest rates in general. I think interest rates maybe have a little bit of a negative connotation behind them.
Okay.
And so, as growing up, interest rates is something bad. Oh, you got to pay interest, and what is interest? All that stuff. But yeah, the Federal Reserve cutting interest rates, it means they've cut their Fed funds rate. It means that the money that you make on maybe a high yield savings account is probably going to go down a little bit. It may impact fixed rates, such as mortgage rates or car loans or something like that, but it's not directly cutting that. A 0.5% cut in the federal funds rate does not mean that mortgage rates go down by 0.5%, which I think is a common misconception. Although interest rates do generally tend to float together across many types of industries. So yeah, there's that.
You touched on something that's really important. So you talked about interest rates. So that the rate of return you might be paid on your savings account, your money market account, your high yield savings account at Robinhood or Marcus or wherever, or your local bank, that's going to go down, right? With the Fed funds rate, the prime rate, and so forth. So that goes down. So interest rates work in both ways, right? So you have the interest you pay when you borrow money, then you have the interest that you earn when you lend money, right? So do you think,
Yes.
David, so here's an interesting question. So when you put money in your high yield savings account on the app, we'll use Robinhood for easy conversational.
Perfect.
Do you think you're lending money to people?
That's a great question. Well, no, what do I know? Yes, I know I'm lending money to somebody. What do you think? No, you think your money's just sitting there and you're getting a nice little added, money to your account at the end of each month.
And isn't that nice of Robinhood? That's so generous of them to take your money and give you more money back. I mean, why are they so generous?
Well, that's why I kind of started off with saying, well, interest rates generally have a negative connotation because it's usually you pay, right? But we can earn interest, as what we're talking about right now. And so the fact that Robinhood might pay me 3%, 4%, 5%, whatever it's been in the past couple of years, it means they're making more than that by lending it out somewhere else or by using it in a higher, way. So yes, they're taking the money that I'm leaving in that account right there, going to use it in more efficient ways for them, and then they'll pay me a little bit of money back to have use and control of my money.
Yeah, so at a personal level, there are these two sides to interest. There's paying it, there's earning it, but earning it typically is by lending it. And I want you to be clear that you're putting it out in the marketplace. So financial institutions, over the course of history of all the time since money has existed, have earned money by using other people's money, right? The largest financial institutions in the world make money on the spread between what they pay us as consumers and what they can earn putting it out someplace else. And that term is called arbitrage, right? It's the spread between money collected and money invested someplace else, which we also can play the game as consumers, right? So, which is called leverage. And so using other people's money to grow your money is leverage, and you're basically playing a game of arbitrage. But every financial institution in the world is how they work, and that's how they become very, very, very wealthy in many cases, on a simple 1 to 2 to 3% spread between the cost of money and what they can earn on that money. And it may not seem that simple, but that's what it is. So it really is that simple. Right.
Exactly. And I'll kind of get into, I guess, my first, I put some money. I'll say I put some money in Marcus. Whenever they came out a couple years ago, 5 years ago, or it was, and I thought it was really cool. I was earning 3% interest, and I'm looking at their fun little graph that they have, and I'll get paid whatever it was, $20-$30 extra a month for leaving my money in there, and in 40 years, my 3% interest will have grown to this, and it looked really cool. But then as you get into other investment vehicles or whatnot, or even just investing in the market, the S&P, that is a term that we might use here. The difference between 3% and 10% is quite significant over long periods of time. But on the flip side of that, it comes with your level of risk tolerance and whatnot. So yes, I think even friends of mine, why would I ever invest in the market when I can earn an easy 4% today in Marcus or in Robinhood or whatever that might be, and they don't realize they might be giving up. Well, over the past 11 months, I don't know what it's at year to date. The market, the S&P, 26%, something like that. So maybe they're giving up quite a bit, but again, riskier. So it's interesting. What are your thoughts?
No, it's a great point. And I didn't know if we knew this conversation would maybe go this direction, because we're talking about interest rates. We're talking both sides of the coin. And so people sometimes are fearful about paying interest because they say, as you said, has a negative connotation. And as we know, there's really only two reasons to borrow money. Two reasons. If you have to,
yep.
Right. So sometimes you have to borrow money. You want to buy an $800,000 house. You don't happen to have $800,000. So maybe you have $100,000. So you need to borrow $700,000. Right. So that's, I have to borrow in that example. And then the same thing would be, well, I want to borrow because there's a benefit to me in borrowing. And that's where leverage comes in, and understanding how interest works for you or against you comes out, right? So using my same 800, 700 example, let's just say you buy an $800,000 house, you could pay cash for it, but your money's earning 3% at Marcus. Well, is that a good return or not? If you put all the money into the house, now it's no longer earning the 3%, right? So now it's in the house, and it is controlled by whatever the house's value is going to go up and down and so forth. On the other hand, maybe you borrow $700,000, and depending on rates, that interest rate could be 4, 5, 6, 7%, right? And then you leave your money invested, but if you're only earning 3%, now you have a difference. Maybe you borrow money at 6 and you're only earning 3. Is that a good thing or a bad thing? I'm not going to address the answer right now. But the reality is you're either going to borrow because you need to, or you need to borrow because you have to. And that takes deep analysis. And there are times where if your rate of return is lower than your cost of money, it still might make sense to borrow, right? Because money can grow quicker. Should we talk about the rule of 72, or is that even?
Sure.
Let me see if I can do this.
Yeah, maybe you can pull up something
here. All right, let me see if this works. All right, so here we have a calculator, right? So the rule of 72 says that your money will double. You take the rate of return on your money, you divide it by 72, and that's how long it'll take your money to double. So David, let's go back to your example at Marcus. Sure. And you said your friends were content to be at 4% because that felt good. So let's just put a number here. So let's just call it $1,000. Is that fair?
That's fair.
All right. So divided by 72. So that $1,000 would do what? It would double. It would double in about 14 years. Right? Makes sense?
Mm-hmm.
So that's a 4%. So that's okay. That might be fine. And then again, so now you have $2,000. It would double again in what? So times 2. Right? So in 28 years, you'll now have $4,000, right? Because you started 1,000, now you got 2,000, now you got 4,000. And it would double again. So that's how it keeps going. But let's say you could earn the same $1,000. Let's say you could earn 8%. Okay? right? So divided by, wait, am I doing this right? I think I'm not.
We had it
What's
wrong.
that?
No, I think we had
I
it
think I
wrong.
think we had it wrong there, Dave.
Yeah.
You take the interest rate.
Yep.
All right, so I had that backwards, right? All right, so let's go back and do this again. So we had 4%. Oh, we have 72. That's funny.
There
No,
you go.
we did it backwards again. Good thing we know what we're doing, huh? All right, so there we had it right. Right, so you take the rule of 72. You take 72 divided by the interest rate you're earning. That's how long it takes for your money to double.
To
Right,
double.
so our $1,000 would take 18 years to double, and then 36 years to double again. All right, so now let's earn 8%. 8% divided by 72. That didn't work either. Sorry, I'm doing backwards. 72 divided by 8. This is why I have to do this every time.
9
Because
years.
9 years, right? So despite that confusion, that's still the math, and that's how it works, right? So now we're at 9 years, so our $1,000 doubled in 9 years, and then it went to $4,000 in 18 years, right? So that's a significant difference, and if you're earning 10 or 12 or 14%, it makes a big difference. So if we think about that rule of 72, what you earn on your investments is really important, what your rate of return is. And there's always a balance, right, between safety, liquidity, and rate of return. You kind of alluded to it before, right? And so why don't you describe what that interplay is between safety, liquidity, and a rate of return?
Yeah. So safety, how safety is basically the risk on what your investment is. So a savings account at Marcus or at Robinhood is probably going to be pretty safe. Those are pretty large institutions, and your money's pretty safe. If you go put it in the stocks or the stock market, it's a little more risky. Generally speaking, the stock market has a positive bias, but has really short term fluctuations and volatility. And then there's even riskier investments beyond that. That I won't really touch on. Liquidity, how quickly you can get to your money. Your checking account, obviously you can get to that money immediately. If I walk down to Bank of America or Wells Fargo, I can pull out my money quickly from my checking or savings account. And then rate of return is, how much you're earning. So we just, talked about Marcus, and maybe that's 4%. Stock market maybe 10% because it's a little riskier. And the correlation, right? The riskier you get, usually the higher return you get, and usually the less liquid it might be. So yeah, anything to add on those three scenarios? And those are all very important. And we talk to all of our clients about that.
Yeah, safety, liquidity, rate of return, and we'll have a correct link to the rule of 72 in our show notes, by the way. So.
And yeah, and we should mention the rule of 72 works both ways, because many of us might have a $1,000 credit card balance.
Yes, thank you.
That's growing interest in the opposite way. Instead of us saving our $1,000 at 4%, all of a sudden our $1,000 credit card balance is growing at 25%. So it works both ways, that your $1,000 might double much quicker.
Yeah, and that balance, because the reality is where we are today, interest rates in the middle to high double digits on credit cards, you're not, that debt's not getting paid off. And if you're paying minimum payments, you're not paying it off. It's growing. It's going negative, and you may or may not realize it. So you got to really watch for that. I felt like something else I want to add in there, but it doesn't matter. Oh, one quick, so about the rule of 72. So if you can earn, so Dave mentioned 10%, right? So if we think about 10%, and we think about the rule of 72, your money is going to double in what? How many years? 7.2 years, right? So the very simple way of thinking about it.
Yeah. If you're earning
10%, it's 7 years, about 7 years. If you're earning 5%, it's 14 years, and so on and so forth, right? So another kind of quick, easy rule of thumb. But the bottom line is you need to be diversified in how you invest, and when you're borrowing money, be thoughtful about what the other side of that coin might be. What are you earning on your other assets and so forth, and how do you make decisions around how much you borrow and the rate of interest. And interest rates are fluid. I'll leave with this, and Dave, I'll have you have a final word. But if people get really stuck on this idea, like if I'm going to get this loan today, whether it's a car loan or a house loan or whatever else it might be, a boat loan, RV, and I'm stuck on this interest rate forever. Interest rates are fluid; they change all the time, right? So they're going up and down, up and down, up and down. They do follow a trend over time. It's not like they change day to day. other than the mortgage world. But so if you end up borrowing a car loan at 7.9%, there's an opportunity. You might be able to refinance that at a lower interest rate, right? And same thing with with the houses and so forth. All right.
Yeah, exactly.
What do you want to add, Dave, and what do you want to wrap up with? Interest rates.
Don't need to add too much other than, yeah, interest rates will be fluid throughout your life, and get advice around them from the proper professionals. And then I think we can link back to our other episode that you'll hopefully listen to about the wealth team.
Yeah,
And you need to have a wealth team to advise you on both sides of this borrowing and investing coins.
absolutely. Great segue. All right. Thank you, David.